All right, so today we're gonna go over what are trading ranges. And the first thing we got to figure out is like why are trading ranges important? It's cool to know what it is, but you gotta know when to use them, how to use them, why to use them. So we use trading ranges as space for opportunity. This is what we're looking at in the market. There's a lot of different things you can see, but what we're doing is looking at the ranges of the market. And in order to take a trade, we want to see a clear range, and we also want to see a retracement of that range at least above or below 50% of the range. So if it's a bearish range, you're going to see 50% above, and if it's a bullish range, you're going to see 50% below. Um, so the key components of a trading range, we just need a strong low or a strong high, depending on if we're bullish or bearish. And then we'll also need a weak high or weak low. With the break of structure, we want to see a run of liquidity before that break of structure. And a range is not completely formed until a weak point is made. That one's really important because you'll start to see things about ranges that they can have a lot of continuations before it's formed, but understand that a range is not formed until the weak point is made. Now, first, let's talk about strong lows. With a strong low, what you're going to see is a low form. And let's go back to our rules right quick. We want to see either strong low or weak high. So in a bullish range, we have a strong low. Every bullish range you have, you're going to have a strong low. Then the weak high. The weak high is going to be the top of the range. So the way you can kind of look at it, and the way that I like to remember it, is naturally we're usually bullish overall on long-term scales as far as markets go anyways. And whenever it looks like you have like this major break of structure or you have a break of structure, if you zoom out a time frame, usually you see that that's just your weak high. So it kind of looks like two breaks of structures, but the weak high is going to be in the bullish markets only. And then a run of liquidity before the break of structure. So right here, you'll see that often I'll draw out like some X, and all this is we had a low right here. So let's say the market probably looks like this right here, right? This is previously a low. The market just came and took out that low, in a sense, giving us like a weak high and probably some other range that was coming from um right here. And whenever the market took out that low, you'll see that it comes up and breaks structure. That's what we mean, or that's what I mean when I say I want to see some type of run of liquidity before the break structure. So essentially, when you have this bullish range, this is what you're going to be expecting. So kind of tying in what we learned in the previous video, the POI is what we're going to mark out on those daily time frames, key levels, whatever it is. And then we also want to see this range form. So we don't just want to take a POI because there's a POI, but we want to see something like this happen, us tap into that POI. And then our target of what we're trying to aim for would then be the weak high left. For a bearish range, it's the same thing but opposite. So you're going to have a strong high in every bearish range that you have. That's going to be the start of the bearish range. And you're also going to have a weak low. And strong high, all that, again, all that's saying is this is strong. Like, this shouldn't be broken. Something strong can't be broken. A weak low is weak. Like, we expect that to be broken. Therefore, that's going to be our target. You might hear in external range liquidity, like you'll hear different terms used interchangeably, but all it is saying that it's weak. It shouldn't hold. This should be a target at some point. But what you're going to see again is a run out liquidity right here, the break of structure, so BOS, and then again that second break of structure going the opposite way. We know that that is just a weak low, and that just completes our range. So again, going over POI, we would have something marked up on our higher time frames. Then we expect some type of action in there and to get our reaction back down to the downside. All right, cool. So now I'm gonna go over just some chart examples. That way you can see how that actually looks with real candles. So here with MES, you'll see that in the market, we had this run of liquidity. So we had this low at one point, and I'll even draw it out to show. We had this low at one point. The market ran back up and then took that low out, eventually coming to break that high, having that break of structure. Then the market came back down for another retracement. And whenever it broke this high, it was right here. Same thing, retracement. Whenever it broke this high, it was this one. And just kind of draw it out again. You see how this is still the same setup that we had for just our textbook example. So it's the same thing. It just you have to train your eyes to see it. And what I'm expecting is this weak low to be formed. Now, remember, we want 50% at least mitigated. So we need a retracement of 50%. What I'm gonna do is grab my Fibonacci tool and just trail it from the top to the bottom here. So before I can take any trade, I would at least want it right here. Now, it doesn't mean it can't get lower and it won't get lower, but at least right there. So let's say we had, for every reason, our POI marked out right here. So we would let the market play out, do what it wants to do. And this is the waiting part of trading. So get into the POI. Now, when you're in this POI, again, once you are at the bottom of that range, once you're below that 50%, this is a daily or 4 hour level, whatever it may be. We would then want to see the market. We could enter here, or we have different ways of entry. We'll go over that later. But you can simply enter here if you would like, and then just aim for that weak high. Again, the weak high is liquidity. That's what we want to get taken out. Market just reacting, doing what you want to do. Cool. Eventually, momentum picks up. And you see it happened over a couple day period. This is day 3. And day 4. Cool. Came to the weak high. So again, all we did was find the range. We had to run liquidity, we had to break structure. And then we had the second break structure, the opposite side, also known as like the weak high. Came down, took out the weak high, took out some liquidity internal. We'll go over that later. We'll start to kind of see how liquidity or the T1 liquidities that I often talk about, you'll start to see how they kind of line up with each other. But that's how you're gonna look at a bullish range. Now for a bearish range, it's gonna be the same thing, right? And just kind of go back to that other picture for reference. Again, right, we're gonna have that run of liquidity at the top, giving us our strong high, break structure. Then run liquidity at the bottom, break structure the opposite way, giving us our weak low. And we're looking for something like this to play out. Whatever POI we have, let tap to that POI. Boom. And of course, you want it below our 50%. I guess in this case, above our 50%. But first thing you can do, mark out that 50% to make sure you get there at least. So the 50% that I'm seeing would be right here. And for us to have a weak low, we would need to see the second break structure. So immediately I know whatever POI I pick is good above this weak high. So you can then, of course, just drawing out a POI, whatever way you find it. That's how you'll find it like we did in the last video. But you expect the market to get to your area. Eventually it gets there, giving you the reaction to start selling down. And then boom, eventually we take out the weak low, fulfill that range.